Hello everyone, welcome back to Swadhyay. In the previous lecture, we have completed revising the chapter PGBP. Today, let us discuss the chapter Income from Capital Gains. This is the chapter overview and we are going to discuss each and every topic in the following order. So, coming to the first topic, that is charging section, section 45. Section 45 serves as charging section for income from capital gains. This section states that any profits or gains arising from the transfer of a capital asset effected in the previous year shall be chargeable to income tax under the head capital gain in the previous year in which the transfer took place. Few important points to notice are the word transfer, the term capital asset, and there is one point, that is any profits or gains arising from the transfer of a capital asset effected in the previous year shall be chargeable to income tax under the head capital gain in the previous year in which the transfer took place. That means in the previous year in which any profit or gain arises in the same previous year, the capital gains shall be subjected to tax. So, the important terminologies to be noted in this statement are transfer and capital asset. Let us discuss what is transfer. Transfer includes the sale, exchange or relinquishment of the asset, or the extinguishment of any rights therein, or the compulsory acquisition thereof under any law. The owner of a capital asset may convert the same into stock in trade of a business carried on by him. Such conversion is treated as transfer. So the first 4 points is sale, exchange, relinquishment of an asset, or the extinguishment of any rights therein, the compulsory acquisition of asset under any law, and the fourth one is conversion of stock in trade into capital asset. Conversion of capital asset into stock in trade. The owner of a capital asset may convert the same into stock in trade of a business. Such conversion is treated as transfer. The fifth point, maturity, redemption of a zero coupon, maturity or redemption of a zero coupon bond. Part performance of the contract. For example, sometimes possession of an immovable property is given in consideration of part performance of a contract. After part performance of a contract, the possession of an immovable property is given as a form of consideration. Lastly, there are certain types of transactions which have the effect of transferring or enabling the enjoyment of an immovable property. For example, a person may become a member of cooperative society, company or other association of persons which may be building houses or flats. There is a cooperative society or a company or other association of persons, and such entity is involved in building houses or flats. When a person becomes member of such entity, when he pays an agreed amount, the society etc. hands over possession of the house to the person concerned. No conveyance is registered. For the purpose of income tax, the above transaction is transfer. This means legally the property has not been transferred to the member, but he is enjoying any benefit derived from such immovable property. Hence, it is considered as transfer for the purpose of income tax law. I hope it is clear for you. So, transfer includes sale, exchange or relinquishment of an asset, extinguishment of any rights therein, compulsory acquisition of asset, conversion of asset into stock in trade, maturity or redemption of a zero coupon bond, any asset possessed as a part performance of the contract, or transferring or enabling the enjoyment of an immovable property. These 7 points are considered to be transfer. What is not a transfer? Section 47 of Income Tax Act specifies certain transactions which will not be regarded as transfer for the purpose of capital gains tax. First, we have discussed what is transfer, and now we are discussing what is not a transfer. And what is not a transfer is discussed in the section 47 of Income Tax Act. Let us see. There are 15 points, 15 transactions which are not considered to be transfer of an asset. The first one is any distribution of capital asset on the total or partial partition of a HUF. Any transfer of capital asset under a gift or will or an irrevocable trust. Transfer of specified capital asset to the government or university, etc. Any transfer of capital asset by a company to its Indian subsidiary company. The parent company or its nominee must hold the whole of shares of the subsidiary company. Let us discuss the first 4 points once again. Any distribution of capital asset on total partition or partial partition of an HUF. Any transfer of capital asset under a gift or will or an irrevocable trust. That means, for example, a person is gifting any property to another person, any of his heir or someone. In such a case, there will be no taxability against the previous owner on such transfer. But when such asset is transferred by the other person, the one who has taken the gift, when such person transfers the capital asset, the capital gains arises and such capital gains will be taxable. Transfer of specified capital asset to the government or university. Any transfer of capital asset by a company to its Indian subsidiary company. The parent company, the condition here is the parent company or its nominee must hold the whole of shares of the subsidiary company. When it is 100% holding company and it transfers its capital asset to Indian subsidiary company, the subsidiary company should be Indian. In such a case, it is not regarded as a transfer. Transfer of capital asset by a subsidiary company to its 100% holding company being an Indian company. Here, the transfer of capital asset is taking place from the subsidiary company to its 100% holding Indian company. Transfer of a capital asset by amalgamating company to amalgamated Indian company in scheme of amalgamation. Transfer of capital asset by the demerged company to the resulting Indian company in scheme of demerger. Transfer or issue of shares by a resulting company in the scheme of demerger. Transfer of shares by a shareholder in a scheme of amalgamation. Transfer of government security outside India by a non-resident to another non-resident. Let us discuss these 6 points once again. So the fifth point says transfer of a capital asset by a subsidiary company to its 100% holding company being an Indian company. The sixth one is transfer of capital asset by an amalgamating company to amalgamated Indian company in scheme of amalgamation. I hope you know that amalgamation means when two companies come together and form a single entity. Either it is merging or purchase of one company by another company. So, when the capital asset is transferred from amalgamating company, the previous companies, the existing companies, to amalgamated Indian company, the previous existing companies are transferring their capital assets to the new company which is formed as part of amalgamation. In such a case, it is not regarded as a transfer. Transfer of capital asset by the demerged company to the resulting Indian company in scheme of demerger. Here, demerger means separation of one company into multiple companies. So, transfer of capital asset by the demerged company, that single company which was existing, to the resulting Indian company in a scheme of demerger. As part of demerger, the capital asset is being distributed among the companies which are now demerged, that is separated from the single entity. The demerged company, which was single entity, the existing company, is now transferring its assets to resulting Indian companies, the multiple companies which are separated in the scheme of demerger. Such transfer of capital asset is not regarded as transfer under section 47. Similarly, instead of capital asset, the transfer or issue of shares by a resulting company in scheme of demerger is also not regarded as a transfer. Transfer of shares by a shareholder in scheme of amalgamation is also not a transfer. Transfer of government security outside India by a non-resident to another non-resident. The government security of India is now transferred to one non-resident by another non-resident who is holding such government security. It is not regarded as transfer. Coming to the 11th point, conversion of preference shares into equity shares. Transfer on conversion of bonds or debentures into shares or debentures. Conversion of gold into electronic gold receipt or vice versa. Redemption of a sovereign gold bonds by an individual. Transfer of capital asset under reverse mortgage. Here, the asset is being converted into a new form. The conversion of preference share into equity share. The transfer on conversion of bonds or debentures into shares or debentures. Conversion of gold into electronic gold receipt or electronic gold receipt into a gold. These three cases of conversion is not regarded as transfer. Redemption of sovereign gold bonds by an individual. When the sovereign gold bonds are redeemed, it is not considered as a transfer. Transfer of capital asset under reverse mortgage scheme. So, these 15 points, these 15 transactions are not regarded as a transfer under section 47 of Income Tax Act. When there is no transfer, there will be no capital gains arising out of such transaction. Hence, there is no taxability in the following 15 cases. Coming to the next terminology from section 45, that is capital asset. So now let us see what is a capital asset. Property of any kind held by an assessee, whether or not connected with his business or profession. Any securities held by a foreign institutional investor which has invested in such securities in accordance with SEBI regulations. Any unit-linked insurance policy issued on or after 1st February 2021 to which exemption under section 10(10)(d) does not apply on account of premium payable exceeding Rs 2,50,000 for any previous years during the term of such policy. The first point stated that property of any kind held by the assessee, whether or not connected with his business or profession. There may be a land which is owned by the assessee. He is selling the land which is used for his personal purpose. Still, on such transfer, capital gain arises and such land will be considered as capital asset. So, the capital gains will be taxable. Any securities held by a foreign institutional investor which has invested in such securities in accordance with SEBI regulations. If foreign institutional investor invests into securities in accordance with SEBI regulations, such securities are also considered as a capital asset. And any unit-linked insurance policy which is issued on or after 1st February 2021. And on such unit-linked insurance policy, exemption under section 10(10)(d) does not apply on account of premium payable exceeding Rs 2,50,000 for any of the previous years during the term of such policy. If such unit-linked insurance policy is to be considered as capital assets, the conditions to be satisfied are it has to be issued on or after 1st February 2021. And there is no exemption under section 10 applicable to such policy. And also the premium payable is exceeding Rs 2,50,000 for any of the previous year during the term of such policy. If these three conditions are met, such unit-linked insurance policy will be considered as capital asset. What is not a capital asset? Stock in trade, consumable stores, raw material held for business or profession. These are used to trade. Stock in trade or consumable stores, raw materials, these are used in either manufacturing process or are used as part of trading in the business of the assessee. In such a case, it is not considered as a capital asset. Personal effects, that is movable property including wearing apparel and furniture held for personal use by the assessee or his family. Personal effects include movable properties including the clothes we wear and furniture held for the personal use by the assessee, the TV or fridge. All these items are considered as personal effects and hence are not considered as capital asset. Rural agricultural land. So, rural agricultural land is also not considered as a capital asset. Let us see, since we are discussing about rural agricultural land, what is not considered as a rural agricultural land. Urban agricultural land, which means area with a population of 10,000 or more, or distances from specified areas as follows. The shortest aerial distance from the local limits of a municipality or cantonment board if it is less than or equal to 2 kilometers and the population is more than 10,000. It is urban agricultural land. If the area, the distance is 2 kilometers, greater than 2 kilometers but less than or equal to 6 kilometers and the population is greater than 1 lakh, it is considered as urban agricultural land. if the distance is more than 6 kilometers but less than or equal to 8 kilometers and the population is more than 10 lakh. In such a case, such area is considered as urban agricultural land and hence is a capital asset. Urban agricultural land is a capital asset. The next point, 6.5 gold bonds of 1977, 7% gold bonds 1980, National Defence gold bonds 1980 and special bearer bonds 1991 issued by the central government are not capital asset. Gold deposit bonds issued under Gold Deposit Scheme 1999 or deposit certificates issued under Gold Monetization Scheme 2015 or 2018 notified by the central government. These gold bonds or gold deposit bonds issued by the central government or notified by the central government are not considered as capital assets. There is a point to be noted here. Jewellery, archaeological collections, drawings, paintings, sculptures are considered as capital assets. So, any transfer of jewellery, archaeological collections, drawings, paintings, sculptures attracts capital gains. Attracts the taxability under the head capital gains. Now let us see different types of capital asset. Generally, if the capital asset is held for more than 36 months, if the period of holding of an asset is more than 36 months, it is considered as long-term capital asset. If the capital asset is not held for more than 36 months, it is short-term capital gain. This is the general rule for any asset, but there are exceptions to this rule. When the capital asset is a security other than a unit listed in a recognized stock exchange in India, other than market linked debenture or a unit of a specified mutual fund, a unit of UTI or a unit of an equity oriented fund or a zero coupon bond. In such cases, the capital asset will be short term if it is held for not more than 12 months immediately preceding the date of its transfer. That means if period of holding of asset is more than 12 months, for such capital asset it is considered as long term capital asset. If it is less than 12 months, it is short term capital asset. A share of a company not being a share listed in a recognized stock exchange in India. In such assets, as well as an immovable property being land or building or both. In the case of these two assets, if the asset is held for not more than 24 months immediately preceding the date of its transfer, it is considered as short term asset. If period of holding of asset is more than 24 months, it is long term capital asset. So, if the period of holding of asset is more than 36 months, it is considered as long term asset, and less than 36 months, it is considered as short term capital asset. Short term capital asset. Exceptions are security other than a unit listed in recognized stock exchange in India, other than market linked debenture and unit of a specified mutual fund, a unit of UTI or a unit of an equity oriented fund or a zero coupon bond. In such a case, if it is held for not more than 12 months, it is short term. If it is held for more than 12 months, it is long term capital asset. A share of a company not being a share listed in a recognized stock exchange in India, or an immovable property being land or building or both. In both these cases, if it is held for not more than 24 months, it is short term capital asset. If it is held for more than 24 months, it is long term capital asset. Now let us head to the next section, section 48, which shows us the mode of computation of capital gains. Let us see how capital gains are computed. So first, we take full value consideration received or accruing on transfer. On transfer of the capital asset, the full value consideration which is received or accruing is taken first. From such amount, we are going to reduce the expenditure incurred wholly and exclusively in connection with such transfer, that is brokerage on sale. The expenditure incurred wholly and exclusively in connection with such transfer should be reduced from full value consideration received or accrued. Any deduction for STT paid is disallowed. STT means Securities Transaction Tax. it is disallowed to be reduced as an expenditure. It considered as an expenditure, and reduction from full value consideration is not allowed. So after reducing the expenditure from full value consideration, we will get net sale consideration. Out of such net sale consideration, we are going to reduce the indexed cost of acquisition and indexed cost of improvement. In case of long-term capital asset, we reduce indexed cost of acquisition and indexed cost of improvement. But in case of short-term capital assets, we are going to reduce cost of acquisition and cost of improvement directly. There is no need to provide for indexation. From that, we are going to reduce any exemptions available under section 54 or 54B or 54D, 54EC or 54F. Section 54 deals with exemptions under the head capital gains, and if the exemption is available or applicable to the capital asset which is being transferred, such exemption amount should also be reduced from net sale consideration. After reducing these amounts, we are going to arrive at a figure called capital gain. It can be either long term or short term. To compute short term capital gain, this above format is used, but we are going to not provide for indexation. What is indexation? So indexation effect is given so as to adjust for any inflation effect on the capital asset, on the price of capital asset. Over time, due to inflation, the prices may vary. So to give effect for such inflation effect, we are going to provide for indexation on long-term capital assets. It is not applicable for short-term capital assets, but for long-term capital assets, we are going to provide for indexation on cost of acquisition as well as cost of improvement. How is indexed cost of acquisition obtained? We can determine indexed cost of acquisition by multiplying cost of acquisition into CII, the cost indexation index in the year of transfer, divided by earlier of CII in the year of acquisition or 2001-2. For indexed cost of acquisition, we will multiply cost of acquisition with CII in the year of transfer divided by either CII in the year of acquisition or CII in the year 2001-2, financial year 2001-2, whichever is earlier. Either the year of acquisition is, if the year of acquisition is before 2001 and 2, we are going to take such year, CII of such year. If it is the year of acquisition is in the year 2001 or 2 or thereafter, we are going to take the CII of 2001 and 2 only. The indexed cost of improvement can be obtained as follows. Cost of improvement multiplied by CII in the year of transfer divided by CII in the year of improvement. Any improvement to the asset before 1st April 2001 are to be ignored. So any improvements made to the asset on or after 1st April 2001 are to be considered, and first such costs incurred on improvement of the asset, we are going to provide for indexation. I have given a table which shows CII, cost inflation indices, for different financial years starting from 2001 to financial year 2023-24. The CII for 2023-24 stands at 348, and for the financial year 2001-2, the CII is 100. The next concept is cost of acquisition. Since from the mode of computation of capital gains, we have come across the term cost of acquisition and cost of improvement. First, let us see what is meant by cost of acquisition and what is cost of improvement. The first one is cost of acquisition. So, the cost of acquisition means the price that the assessee has paid or the amount that the assessee has incurred for acquisition of the asset. The price the assessee has paid or the amount that assessee has incurred for acquisition of asset is cost of acquisition. Expenses incurred for completing the title are a part of the cost of acquisition. Any expense incurred for completing the title of such asset are also considered to be cost of acquisition. For example, stamp duty. Let us see what is the cost of acquisition under different circumstances and for different assets. The first case is the general rule where such capital asset become the property of assessee before 1st April 2001. The cost of asset to the assessee or FMV as on 1st April 2001 at the option of assessee is considered to be cost of acquisition. Either the real cost of asset, the real cost incurred by the assessee to acquire such asset, or the fair market value of such asset as on 1st April 2001. At the option of assessee, any of such will be considered as cost of acquisition. In the case where the capital asset has been acquired by the assessee, it became the property of the assessee before 1st April 2001. The second case, capital asset became assessee's property due to distribution of assets on total or partial partition of HUF by will or gift or revocable or irrevocable trust or succession or inheritance or devolution, etc. On distribution of assets on liquidation of company, transfer from holding company to its wholly owned subsidiary or Indian subsidiary company to 100% holding company. Transfer from amalgamating company to amalgamated company. Transfer from demerged company to resulting Indian company. Individual bringing his separate property into HUF. If you can see the first point, distribution of assets on total or partial partition of HUF by will, gift or irrevocable trust. Transfer from holding company to its subsidiary and subsidiary to holding. Transfer from amalgamating company to amalgamated company or demerged company to resulting company. These are the cases which are not considered as transfer. But for the purpose of income tax, even if the transfer has not been taken place, since the assessee is now possessing the property, in such cases, what will be the cost of acquisition for assessee? Let us see. The cost for which the previous owner of the property acquired it, or FMV as on 1st April 2001 at the option of assessee. In all the given cases, the asset is not purchased by the assessee by paying some amount. It has been acquired by him from some other person. In such a case, the other person, whatever the cost is incurred by the previous owner, it will be considered as cost of acquisition, or the fair market value as on 1st April 2001 will be taken as cost of acquisition at the option of assessee. Even in case the individual bringing his separate property into HUF, a personal property of individual is now being brought into the HUF so that the HUF can use it for its purpose. In such a case also, the cost of acquisition or FMV as on 1st April 2001 at the option of assessee will be considered as cost of acquisition of such capital asset. The cost of property in the hands of previous owner cannot be ascertained. There might be cases where we cannot ascertain what is the cost incurred by the previous owner of such asset. In such a case, FMV on the date on which capital asset became the property of previous owner can be considered. Here we have taken cost for which previous owner of the property has acquired it, but it is not ascertainable. The cost for which the previous owner has acquired the asset is not ascertainable. We cannot determine. In such cases, the FMV as on date on which the capital asset has been acquired by the previous owner can be taken as cost of acquisition of such capital asset. The third case, goodwill, trademark, brand name, etc. In case of self-generated goodwill, the cost of acquisition will be nil. But if such intangible assets are acquired from any previous owner, then the purchase price minus any depreciation on such intangible assets will be considered as cost of acquisition. If the assessee acquired on total or partial partition of HUF under a gift or will by succession, inheritance, distribution of assets on liquidation of a company, etc., and previous owner acquired it by purchase, these intangible assets are acquired by assessee by not paying any certain cost, by not paying any certain sum. But the previous owner of such intangible assets has acquired these assets by purchasing. In such a case, the purchase price to the previous owner will be the cost of acquisition of the capital asset to the assessee. I hope it is clear for you. The fourth case is any other capital asset. Conversion of inventory into capital asset. In such a case, fair market value of the inventory as on date of such conversion. Conversion of inventory into capital asset. On the date of such conversion, whatever the fair market value of the inventory is, it will be considered as cost of acquisition of such asset. Electronic gold receipt acquired by assessee on transfer of gold. The cost of gold in the hands of the person in whose name electronic gold receipt is issued is the cost of acquisition of the electronic gold receipt. On release of gold on such electronic gold receipt, the cost of electronic gold receipt in the hands of such person will be cost of acquisition of gold on its realization. I hope it is clear for you. First, we have discussed 4 cases. The general case, if the asset has become the property of assessee before 1/4/2001. The second case is capital asset became the assessee's property without him paying any cost from his pocket. The third case is goodwill, trademark or brand name. In case of intangible assets, we are focusing on the nature of asset here. Instead of the circumstance, we are focusing on the nature of asset being intangible asset. And the fourth case is any other capital asset such as conversion of inventory into capital asset, or electronic gold receipt is acquired by assessee by transferring gold, or such gold is realized on electronic gold receipt, These are the cases covered in our fourth case. The fifth one is regarding shares. The capital asset here is shares. Shares can be right shares or bonus shares, or there are few more cases where the transfer of shares can be seen, and in such cases what will be the cost of acquisition? Let us discuss one by one. So the first case is right shares. When the right shares are issued, following 4 are the circumstances. The first circumstance is right shares acquired by the assessee. Right shares are issued by the company and the assessee is acquiring such right shares. In such case, the amount actually paid by him for acquiring the right shares is the actual cost of acquisition of such right shares. But there might be cases where the rights entitlement, which is renounced by the assessee in favor of a person. Whatever the right shares are eligible for the assessee to acquire, they are now being renounced by the assessee. The right is being transferred to some other person by the assessee. In such a case, since the right shares are not acquired by the assessee, there will be no acquisition, hence no cost of acquisition. The COA will be nil. The third circumstance is right shares which are purchased by the person in whose favor the assessee has renounced the rights entitlement. In the second circumstance, we have seen that the assessee is transferring such right entitlement to other person. He is renouncing the right. He is not acquiring such assets. So, the right shares which are purchased by such other person in whose favor assessee has renounced the rights. For him, the cost of acquisition of right shares will be amount of the purchase price paid by him to the person renouncing such right and the amount paid by him to the company or institution for acquiring such shares. First, such person will pay amount to assessee. Amount of purchase price paid by him to the person renouncing such right. First, he will pay amount to assessee. Now, for acquiring the right shares, he will pay amount to the company or institution for acquiring the shares of such company or institution. Both these amounts will be considered as cost of acquisition of such right shares. The fourth circumstance is original shares on which rights have been issued. What is the cost of acquisition? Amount actually paid for acquiring the original shares. It is simple. So, these are the 4 circumstances for right shares. And the cost of acquisition for 4 circumstances are discussed. The next case is bonus shares. Generally, for bonus shares, cost of acquisition is nil. But if the bonus shares are allotted before 1st April 2001, although there is nil cost of acquisition, no cost is paid by assessee, assessee can opt for FMV as on 1st April 2001 as cost of acquisition of such bonus shares. RCC can opt for fair market value as on 1st April 2001 of such bonus shares allotted if they are allotted before 1st April 2001. Third case, shares in Indian Amalgamated Company obtained from amalgamating company. The cost of acquisition of the shares in the amalgamated company is the cost of acquisition of shares in Indian Amalgamated Company. Conversion of bonds or debentures or debenture stock deposit certificates to shares or debentures. When the bonds or debenture stock or deposit certificate is converted into share or debenture. In such a case, the part of cost of debentures or debenture stock or bond or deposit certificate, whichever is converted, in relation to which such shares or debentures are acquired, such cost, the part of such cost of debentures whichever are converted, will be considered as cost of acquisition of such shares or debentures. Transfer of specified security or sweat equity share. We will consider the fair market value of such security or sweat equity share. Conversion of preference shares into equity shares. That part of cost of preference share in relation to which such equity shares are acquired by the RCC will be the cost of acquisition. The part of the cost of preference share in relation to which the equity share is acquired by the RCC. It is considered as cost of acquisition of such equity share by the RCC. The next case is shares of resulting company on account of demerger. The cost of acquisition will be calculated as follows. First, we will take cost of acquisition of shares held in the demerged company, and to such cost we are going to multiply the net book value of assets transferred in a demerger. Net book value of assets transferred in a demerger divided by the net worth of the demerged company, that is the aggregate of the paid up share capital and general reserves. So the cost of acquisition of shares held in demerged company into net book value of assets transferred in the demerger divided by the net worth of the demerged company. Net worth means aggregate of paid up share capital plus general reserves. This will be the cost of acquisition in case of acquiring shares of resulting company on account of demerger. The last case is land and building. If the land and building is acquired before 1st April 2001, the cost of asset to the RCC or FMV as on 1st April 2001 at the option of RCC will be the cost of acquisition of such land or building. However, FMV as on 1st April 2001 shall not exceed the stamp duty value as on 1st April 2001. The fair market value will be subjected to the value of stamp duty value as on 1st April 2001. Now let us discuss what is cost of improvement. Any cost incurred by the assessee on improvement of the capital asset will be reduced from the fair value consideration, from the net sale consideration, to calculate the capital gains. Improvement includes any repairs or reconstruction, etc., but it does not mean replacement of asset or remodeling, renovation of the asset. So let us see different assets for which how the cost of improvement varies. For goodwill or any other intangible assets. For intangible assets, the cost of improvement will be nil. There will be no cost of improvement for goodwill or intangible assets. But for any other capital asset, when the capital asset became assessor's property due to distribution of assets on total or partial partition of HUF by will or gift or revocable or irrevocable trust or succession or inheritance or devolution, on distribution of assets on liquidation of company, transfer from holding company to its wholly owned subsidiary or Indian subsidiary company to 100% holding company, transfer from amalgamating company to amalgamated company, transfer from demerged company to resulting Indian company, individual bringing his separate property into HUF, where the assessee has acquired the capital asset without paying any cost from his own pocket. In such a case, the cost of improvement will be the capital expenditure incurred in making any addition or alteration to capital asset. It is not routine expenses or repairs and maintenance incurred on such asset. The capital expenditure incurred in making any addition or alteration to the capital asset is considered as cost of improvement. If such cost on improvement is incurred before 1st April 2001, in such a case, we have to include the capital expenditure incurred on or after 1st April 2001 by the assessee. If the asset, if the cost on improvement of the asset has been incurred before 1st April 2001, we are not going to take any cost of improvement before 1st April 2001. Hence, we are going to take any capital expenditure that is incurred only on or after 1st April 2001 by the assessee. We should not include any cost of improvement on the capital asset which has been incurred before 1st April 2001. The second case is where the capital asset became the property of the previous owner before 1st April 2001 but became the property of assessee on or after 1st April 2001. Previous owner acquired the capital asset before 1st April 2001 but the assessee acquired the property from the previous owner on or after 1st April 2001 in these above modes, any of such above mode. In such a case, the capital expenditure incurred on or after 1st April 2001 by both previous owner and the assessee will be considered. Capital expenditure before 1st April 2001 is not considered, but on or after 1st April 2001, whatever the capital expenditure incurred in the hands of both previous owner as well as the assessee will be taken as cost of improvement. If the cost of improvement is incurred on or after 1st April 2001, all the capital expenditure incurred by the previous owner as well as the assessee will be the cost of improvement while calculating the capital gains. Other cases. The cost on improvement is incurred before 1st April 2001. The capital expenditure incurred on or after 1st April 2001 by the assessee will be considered. Here I am talking, the other cases means the asset is acquired by any mode other than these modes. The asset becomes assessee's property by any mode other than the modes mentioned in point A, other than these modes. In such a case, the capital asset is, if it is acquired before 1/4/2001, 1st April 2001, the capital expenditure incurred on or after 1st April 2001 by the assessee will be taken as cost of improvement for calculating the capital gains. If the capital asset, if the cost on improvement is incurred on or after 1st April 2001, the capital expenditure incurred by the assessee after it became the assessee's property only will be considered. If it is, if the cost of improvement is incurred on or after 1st April 2001, only the capital expenditure incurred by the assessee will be considered. For the above modes only, for the cases discussed in point A, only for these cases we are going to consider cost of improvement incurred by the previous owner also. Since the assessee has not paid any amount from his pocket during the acquisition of the asset, we are going to consider any cost of improvement incurred by the previous owner in these cases. But in case of other cases, whatever the capital expenditure incurred by the assessee will only be considered as cost on improvement while calculating the capital gains. I hope it is clear for you. Having discussed the cost of acquisition and cost of improvement, now let us head back to the section 45, the charging section which we have discussed before. So going back to the section 45 again, which discusses about the scope and year of chargeability. Section 45 states that capital gains are chargeable as income of the previous year in which sale or transfer takes place. The sale or transfer of capital asset takes place in the previous year in which the sale or transfer of capital asset takes place. For such previous year, we are going to charge the income tax on capital gains. But there are exceptions to this rule. That means instead of in the year of sale or transfer, we are going to charge capital gains in some other PY. What are the cases? Let us see one by one. The first case is in case of insurance receipts. Any money received or other assets obtained under any insurance from an insurer on account of damage to or destruction of any capital asset is received by the assessee. Any money received or other assets obtained by the assessee under any insurance policy from the insurer on account of damage of the asset or destruction of any capital asset. Such money received or asset obtained will be taxable in the year in which such amount or asset is received. The damage or destruction should have been caused due to flood, typhoon, hurricane, cyclone, earthquake or other convulsion of nature, riots or civil disturbances, accidental fire or explosion, or of action by an enemy or action taken in combating an enemy, whether with or without declaration of war. In such cases where any damage has been incurred or destruction of capital asset has been caused and the insurance policy is covering such assets, the insurer will pay any money or any asset will be replaced with such damaged asset. In such a case, the taxability will arise in the year in which such amount is received by the assessee or such asset is received by the assessee. The value of money or the fair market value of the other assets on the date of such receipt shall be deemed to be full value consideration received or accruing as a result of the transfer of such capital asset. So while computing the capital gains, first what we take the amount we consider is we will take the full value consideration first. From such amount we are going to reduce expenses, cost of acquisition, improvement or any exemptions etc. to arrive at a figure called capital gain. So the value of any money or the fair market value of other assets, either the money received or the fair market value of the asset replaced on the date of such receipt shall be deemed to be full value consideration, full value of the consideration received or accrued as a result of the transfer of such capital asset for the purpose of computing the capital gain. So here instead of the year of transfer or destruction whatever or damage, we are going to consider the previous year in which the amount is received by the assessee or asset has been received by the assessee, and in such previous year we are going to tax the capital gain. To arrive at capital gain, we will take the full value consideration as the sum of money received or the fair market value of such asset. From that we are going to reduce the cost of acquisition and we will arrive at the capital gain amount, which will be taxable in the previous year in which the asset has been obtained or the money has been received by the assessee from the insurer. The second case is conversion or treatment of a capital asset as stock in trade. Both capital gains and business income are chargeable to tax in the year in which stock in trade is sold or otherwise transferred. When the capital asset is converted into stock in trade, it will be the taxability will arise under the head PGBP as well as capital gains. Let us see how. The full value consideration under the head capital gains, first we will see the full value consideration. The full value of consideration received is equal to the fair market value of the asset on the date of such conversion or treatment. On the date of conversion of capital asset to stock in trade, whatever the fair market value of the asset is there, it will be considered as the full value of consideration received. The income chargeable under the head capital gains is equal to fair market value on date of conversion minus cost of acquisition or indexed cost of acquisition or improvement. And the CII, while computing the long term capital gain, we are going to provide for indexation effect. We are going to give the indexation effect. The cost inflation index of the year of conversion should be taken. Instead of year of transfer, we are going to take the CII of year of conversion in case of long term capital asset. So FMV minus COA or COI, or FMV minus indexed COA or COI will be the income chargeable under the head capital gains. Similarly, the income chargeable under the head PGBP is equal to sale price of stock in trade minus FMV on the date of conversion. Whatever the sale price the stock in trade carries, that means the sale price at which the person assessing in general sells such stock, minus FMV on the date of conversion will be the income chargeable under the head PGBP. So while converting a capital asset into stock in trade, the taxability will arise under the both heads, capital gains as well as under the head PGBP. For capital gains, we are simply going to take FMV on date of conversion, and we are going to reduce the cost of acquisition or improvement, or indexed cost of acquisition or improvement in case of long term capital asset. Such difference amount will be considered as income chargeable under the head capital gain. Under the head PGBP, the sale price of such stock in trade, on sale of such stock in trade, whatever the sale price is there, from that we are going to reduce the fair market value on date of conversion. Simply put, sale price minus purchase price will be the profit, right? So we are going to reduce the fair market value on date of conversion from the sale price of stock in trade whenever such stock in trade is sold. And in such year, the income under the head PGBP will be chargeable for tax. I hope it is clear for you. Now let us head to the third case, the compensation on compulsory acquisition. On compulsory acquisition of any capital asset by the central government or any authority, the compensation will be paid for owner of such capital asset. The capital gain arisen on amount paid by the central government on compulsory acquisition of any land or building or other capital asset is subjected to tax under the head capital gains. Such compensation amount paid is taxable in the year of receipt. If such compensation is received in installments, the entire amount will be taxable in the year of receipt of first installment. It is mentioned that the compensation amount will be taxable in the year in which it is received. But if the compensation is received in installments in different years, the entire amount will be taxable in the year of receipt of the first installment, that is when it is accrued itself. Enhanced compensation. There might be a case where if the assessee approaches court of law for enhancement, that is increase in the value of compensation. If assessee approaches court of law for enhancement, the enhanced amount of compensation minus original compensation shall be taxable under the head capital gains in the year of receipt. When assessee approaches court of law for enhancement in compensation, the enhanced amount of compensation minus original compensation shall be taxable under the head capital gains in the year of receipt of such enhanced compensation. If such enhanced compensation is received in installments, it shall be taxable in the year of receipt of such installment to the extent it is received only. In the above case, the compensation is fixed before itself. So, even if it is received in installments in different years, the entire amount will be taxable in the year of receipt of first installment itself. But in case of enhanced compensation, whenever the enhanced compensation is really received, to the extent it is received will be taxable in the year of such receipt. The cost of acquisition or cost of improvement in case of enhanced compensation shall be nil. Reduction of enhanced compensation. The capital gain has been charged on compensation or enhanced compensation, and subsequently the court reduces compensation amount. Then recomputation of assessed capital gain is done by considering the reduced amount by way of rectification. Here the assessee has computed the capital gain as per the compensation he has received or any enhanced compensation. But subsequently, the court says to reduce the compensation amount. That means unnecessarily the assessee has to bear the excess tax burden. So the assessee has an option to recompute the capital gain as per the reduced compensation amount by way of rectification. Instead of paying higher tax, he can pay the exact tax amount as per the compensation he has received after the court has reduced such compensation amount. Death of transferor. The enhanced compensation will be chargeable to tax in the hands of the person who receives the same. The transferor, when the transferor passes away, whatever the compensation is received by his successor or her or his family, in hands of such assessee, the enhanced compensation will be chargeable to tax. It will be chargeable to tax in the hands of the person who receives the same in case of death of transferor of the capital asset. These are the cases in which instead of in the year of transfer of the capital asset, the capital gains are chargeable to tax based on different circumstances. What are the circumstances? In case of insurance receipts, in case of conversion or treatment of capital asset as a stock in trade, or compensation or on compulsory acquisition of land or building or any capital asset. Now let us head to the next section, section 46. We have completed discussing how the capital gains are computed. From the computation of capital gains, we have come across the terms like cost of acquisition, cost of improvement, and what is indexation, how it will be affected. So after that, we have seen the circumstances where instead of in the year of transfer of the capital asset, the capital gains are chargeable to tax in the other year based on the circumstances. We have discussed 3 such cases under section 45. We have completed section 45 and now we are heading to section 46, that is capital gains on distribution of assets by company on liquidation. When the assets of the company are distributed on liquidation, how the capital gains will be calculated. Let us see. The first is in the perspective of liquidated company, in the hands of liquidated company, what will be the tax liability? It is not regarded as transfer when the assets are distributed among shareholders, hence no tax. In case of liquidation of a company, when the assets are distributed among the shareholders, it is not regarded as a transfer, hence there will be no tax liability for the company. But if the liquidator sells the assets of the company, which is resulting in capital gain, and distributes the funds so collected, such gains shall be taxable. Generally, when the assets are distributed among the shareholders as per the shareholding, there will be no capital gain arising. It is not regarded as transfer in the first place. When there is no transfer, there is no taxability of capital gains. But if the liquidator is selling those assets of the company, and on realization of such assets, there is a capital gain, there is a profit on sale of such asset, and such funds so collected are distributed among the shareholders. In such a case, the gains shall be taxable in the hands of liquidated company. The profit so obtained on sale of such assets, on realization of such assets, will be considered as capital gain and hence shall be taxable in the hands of liquidated company. In the hands of shareholders, the taxable amount shall be, the taxable amount under the head capital gains shall be fair value consideration is equal to money received plus FMV of assets distributed minus deemed dividend. If shareholder receives any money, such money received will be taxable amount, plus if the shareholder has also acquired any of the assets, the fair market value of such assets so distributed will be considered, minus deemed dividend. we are reducing the deemed dividend amount from the capital gain while computing the capital gains, because deemed dividend will be taxable under the head income from other sources. We are not going to tax deemed dividend under the head capital gains. It belongs to the category income from other sources. It is income from other sources. Hence, we are going to reduce the deemed dividend amount from the money received plus the FMV of assets distributed while computing the taxable amount under the head capital gains. So, this is all about section 46. Heading to the next section, section 46A. Capital gains arising on buyback of shares or specified securities. Here the company is buying back its own shares or specified securities. In such a case, what will be the taxability? Taxability in the hands of company. If the company is domestic company, it is subjected to additional income tax at the rate of 23.296%. That means 20% is the tax rate, to which we are going to add 12% surcharge and 4% cess. On buyback of such shares, the domestic company has to pay additional income tax at the rate of 23.296%. But if the company is other than domestic company, there will be no tax liability for the company. And for buyback of specified securities by any company, there will be no taxability in the hands of such company. Taxability in the hands of shareholder or holder of specified securities. Since the domestic company is already paying additional income tax on buyback of its shares, there will be no tax liability for the shareholder of such shares or holder of such specified securities of the company. Hence, it will be exempt income in case of shareholder or holder of specified securities. When the company buys back the shares or securities from such shareholder or holder of specified securities, it will be exempt income. The income will not be taxable for such persons. The income will be taxable in the hands of company itself in case of domestic company. In case of other than domestic company, since the company is not paying any tax, the shareholder or the holder of specified securities will be liable to pay tax on such income. The income arising to the shareholder is taxable as capital gains on buyback of shares or specified securities by the company from such holder of shares or specified securities. Similarly, in case of buyback of specified securities by any company, income arising to the holder of specified securities is taxable as capital gains. The value of consideration minus cost of acquisition shall be taxable. So, this is all about section 46A, that is capital gains arising on buyback of shares or specified securities by a company. Now, let us head to section 50. We have completed discussing section 45, 46. Section 47 talks about transactions which are not considered as transfer, which we have already discussed before. Section 48 is mode of computation of capital gains. We have completed revising that part. Section 49 deals about cost of acquisition of assets. We have seen different circumstances as well as for different capital assets what is the cost of acquisition. Now, the next section we are going to discuss is section 50, that is computation of capital gains in case of depreciable assets. Section 50 is mainly applicable for those who are engaged in any business or profession. Generally, depreciation is provided by businessmen or professionals, right? So, section 50 is applicable on depreciable assets. Hence, the persons who are paying tax on whose income arises under the head PGBP, for such persons, section 50 will be applicable. From the previous chapter, PGBP, we know that depreciation is charged on block of assets. Instead of individual assets, we will be charging depreciation on a block of asset. Any income from transfer of depreciable asset is deemed to be capital gain on short-term capital assets irrespective of period of holding. in case of depreciable assets, we are not going to consider the period of holding. All the assets will be short-term capital assets, and any gain arising on transfer of such short-term capital assets, depreciable assets, will be short-term, deemed to be short-term capital gain, and such short-term capital gain will be subjected to tax under the head C, income from capital gains. There are 3 cases for depreciable assets. There are 3 circumstances under which the capital gains may differ on sale of such depreciable assets. Let us see one by one. The first case is block of assets sold whole or part. When the block of asset is sold whole or part and the consideration received on transfer is greater than written down value at the beginning of previous year plus cost of acquisition of asset acquired in the previous year plus any expenditure incurred. That means the WDV at the beginning of previous year. To such, if there is any asset acquired in the previous year, we are going to add the cost of acquisition of such asset and any expenditure incurred. This is the value of such block of asset. But the consideration received on transfer of such capital asset is more than the value of block of asset. In such a case, the excess amount, the difference between consideration and value of block of asset, the excess amount shall be taxable as short-term capital gain. We are getting a gain on transfer of such block of assets. So, we are going to consider such excess amount as short-term capital gain. The second case is block of assets sold whole. The whole block of assets is being sold and the consideration is less than WDV at the beginning of PY plus cost of asset acquired in the previous year plus any expenditure incurred. The consideration is less than the value of asset. Then the difference amount shall be short-term capital loss. Since the consideration is less than the value, the loss is being incurred by the assessee and the difference will be treated as short-term capital loss. The third case is block of assets sold in part. That means the whole block is not sold, only a part of block of assets is being sold. And the consideration is less than WDV at the beginning of previous year plus cost of asset acquired in the previous year and any expenditure incurred. The consideration is less than the whole block of assets, but only part of block of asset is being sold. Simply we will take the difference amount as WDV of the block at the end of previous year. The difference amount between consideration and the WDV and the value of block of asset will be taken as written down value of the block of asset at the end of previous year. I hope it is clear for you. There will be no capital gain arising in the third case. Cost of acquisition in case of power sector assets shall be WDV of the assets so adjusted. We know that in case of power sector, the assets are depreciated as per SLM basis, but we are going to adjust the value of asset to written down value and then we are going to calculate the cost of acquisition. The cost of acquisition shall be WDV of the asset after the adjustment. The next section is section 50A. Computation of capital gains in case of market linked debentures. Any capital gain arising from the transfer or redemption or maturity of unit of a specified mutual fund acquired on or after 1st April 2023 or market linked debenture would be deemed to be short-term capital gain. Any capital gain is deemed to be short-term capital gain if it is arised on transfer or redemption or maturity of market linked debenture or on transfer or redemption or maturity of unit of a specified mutual fund which is acquired on or after 1st April 2023. And what is the value of such capital gain? How are we going to compute the capital gain amount? Capital gain is equal to FVC, full value of consideration received or accrued, minus cost of acquisition plus expenditure incurred wholly and exclusively on such transfer or redemption or maturity. Since it is short-term capital gain, we are not going to give indexation effect. So we are going to simply take cost of acquisition plus any expenditure incurred wholly and exclusively on such transfer or redemption or maturity will be reduced from the full value of consideration received or accrued to arrive at the capital gain figure. No deduction with respect to STT paid shall be allowed. Securities transaction tax paid shall never be allowed as deduction while computing the capital gain. Now, let us discuss the next section. Section 50B. Slump sale. Slump sale means here the whole undertaking is valued and it is sold as a whole. Instead of dividing it into parts, the whole undertaking is sold as a whole. The transfer of one or more undertakings for a lump sum consideration without values being assigned to individual assets and liabilities. The transfer of one or more undertakings for a lump sum consideration without values being assigned to individual assets and liabilities is called slump sale. If undertaking is held for more than 36 months, the long-term capital gains will arise on such transfer. If it is held for not more than 36 months, short-term capital gains will be arising. The general rule, the period of holding, if it is more than 36 months, it will be LTCG. If the period of holding is less than 36 months, for not more than 36 months, it will be STCG on transfer of such undertaking. How is capital gain computed on slump sale? Capital gain is equal to full value of consideration received minus deemed cost of acquisition or cost of improvement. Simply put, capital gains means full value of consideration received minus cost of acquisition or any cost of improvement. But what is the full value consideration in case of slump sale? The full value of consideration is equal to higher of FMV1 or FMV2 of capital assets. Let us see what is FMV1 and FMV2. FMV1 is equal to fair market value of capital assets transferred by way of slump sale on date of slump sale. FMV2 means fair market value of consideration received, either monetary and non-monetary, as a result of slump sale. FMV1 means fair market value of capital assets transferred on the date of slump sale. FMV2 means fair market value of consideration received, either monetary and non-monetary, as a result of slump sale. Higher of FMV1 or FMV2 is taken as full value of consideration on transfer of such capital assets. What is the deemed cost of acquisition? Deemed cost of acquisition is nothing but net worth of such undertaking. We know that net worth means aggregate value of total assets of the undertaking minus value of liabilities as per books of accounts. We are going to take the aggregate value of total assets of the undertaking, and no revaluation of assets is considered here. From such assets, we are going to reduce the value of liabilities as per the books of accounts. So we will arrive at net worth. Such net worth is nothing but deemed cost of acquisition while computing the capital gains on slump sale. A point to be noted here is no indexation benefit shall be availed in case of slump sale. Even if the period of holding is more than 36 months, indexation benefit cannot be availed in case of slump sale. How are we going to take the value of assets while calculating deemed cost of acquisition? For depreciable assets, we are going to take the written down value of such assets. As per the income tax provisions, we are going to depreciate such assets, and the written down value of such depreciable assets will be deemed as the cost of acquisition, the value of such assets, while computing the cost of acquisition. Similarly, in case of self-generated goodwill, the value will be nil. Capital assets whose expenditure is allowed under section 35 AD. 35 AD deals with the expenditure incurred on capital assets for the purpose of scientific research. So for capital assets whose expenditure is disallowed under section is allowed under section 35 AD, the value of such assets will be taken as nil. Since already deduction has been provided under section 35 AD, for these capital assets, the value will be taken as nil while computing deemed cost of acquisition in case of slum sale. For other assets, which are not depreciable assets and which are not the assets covered above, the book value of such assets will be considered while computing the deemed cost of acquisition. So this is all about slum sale, that is section 50B. Now let us head to section 50C, capital gain on sale of land or building or both. There are different conditions here. The first condition is where the stamp duty value of such land or building or both is greater than the actual consideration received or accrued. The stamp duty value of such capital asset is more than the actual consideration received. In such a case, what will be treated as the sale consideration? If the stamp duty value is greater than 110% of actual consideration, we will see if the actual consideration is 100, let us suppose, stamp duty value is 120. What is the 110% of actual consideration? It is rupees 110. I am taking simple figures for easy understanding. So here 110 is 110% of actual consideration. SDV is 120. In such a case, deemed sale consideration will be 120. Here assessing officer will be of opinion that the actual consideration is less than SDV so as to reduce the tax burden on the capital gain arising on transfer of such capital asset. Hence, the deemed sale consideration, if the stamp duty value exceeds 110% of actual consideration, will be stamp duty value itself. If SDV does not exceed 110% of actual sale consideration, SDV is greater than actual consideration. Let us take actual consideration is 100, SDV is 105. In such a case, the actual sale consideration, that is 100 rupees, will be deemed sale consideration. This is the first condition. The second condition is where actual consideration is greater than SDV. In such a case, higher amount, that means actual consideration will be deemed sale consideration. When assessee claims that SDV exceeds fair market value of asset on date of transfer and assessing officer refers the valuation by valuation officer on such claim. This is the third case. The assessee claims that stamp duty value exceeds the fair market value of asset on date of transfer. It is the claim by assessee. In such a case, what assessing officer does is he will refer the valuation of such capital asset by a valuation officer on such claim. Then, on valuation, if the value of capital asset as ascertained by the valuation officer exceeds the stamp duty value, then the sale consideration, deemed sale consideration, will be stamp duty value itself. If the value ascertained by the valuation officer is less than stamp duty value, the value ascertained by the valuation officer will be deemed sale consideration. That means the lower value is taken if the valuation officer ascertains the value of the capital asset on a claim made by assessee that SDV exceeds FMV of asset on date of transfer. Here the assessee is claiming that the stamp duty value is more than the fair market value of asset on date of transfer. In such a case, when valuation officer is referred to value the to ascertain the value of the capital asset, we will see the lower of the value ascertained by the valuation officer or SDV, the stamp duty value, will be deemed sale consideration of such capital asset. I hope it is clear for you. Let us see one important point. Let us go through one important point. If the date of agreement is different from the date of transfer, The date of agreement is different from the date of transfer of the capital asset. The stamp duty value on date of agreement is considered if whole or part of the consideration is received by way of account pay check or bank draft or ECS or prescribed electronic mode. The prescribed electronic modes are IMPS, UPI, RTGS, NEFT, net banking, debit card, credit card or Bheem Aadhaar Pay. On or before the date of agreement. If on or before the date of agreement, the whole or any part of consideration is paid by way of any of these four modes, only in such a case, the SDV on date of agreement is considered. Otherwise, SDV on the date of transfer has to be considered. I hope it is clear for you. The condition is if on or before the date of agreement, either whole or part of consideration is received by way of any of these four modes, only then SDV on date of agreement is considered. Otherwise, SDV on date of transfer has to be considered while valuing deemed sale consideration for on the transfer of land or building or both. So, from this deemed sale consideration value, we are going to reduce any incidental expenses to arrive at net sale consideration. From such net sale consideration, we are going to reduce cost of acquisition or improvement or indexed cost of acquisition or improvement. If there is any exemption available under section 54, we are going to reduce such amount to arrive at capital gain on sale of land or building or both. This is how capital gains are computed on sale of land or building or both. The first step, the full value of consideration or deemed sale consideration, how it is determined, that is what we have learnt in the section 50C. The next section is 50CA. Fair market value deemed to be full value of consideration in case of transfer of unlisted shares. 50CA talks about the unlisted shares, the transfer of unlisted shares, and the case where the fair market value is deemed to be the full value of consideration in case of transfer of unlisted shares when the sale consideration on such transfer is less than fair market value of such share determined in prescribed manner. Even if the fair market value is 100 rupees, the sale consideration on such transfer is 90 rupees only. When sale consideration is less on transfer of unlisted shares, here we are going to consider the higher amount. That means the fair market value of such shares is deemed as full value of consideration on transfer of unlisted shares. Section 50D. Fair market value deemed to be full value of consideration in certain cases, where the consideration received or accruing as a result of the transfer of a capital asset by an assessee is not ascertainable or cannot be determined. When consideration received or accruing as a result of transfer of a capital asset by an assessee is not ascertainable or cannot be determined. In such a case, fair market value will be deemed as full value of consideration received or accrued. That is what section 50D talks about. The next section, having completed the section 50, now we are heading to section 51. Advance money received and forfeited. Where the assessee has received advance money earlier for transfer of capital asset, but the transfer could not be effected due to failure of negotiations. Let us consider assessee has received some amount from any person for transfer of capital asset, but the transfer has not taken place due to failure of negotiations, and such other person is not coming back and claiming such advance money he has paid to the assessee. Still the advance money is kept with the assessee. In such a case, up to 31st March 2014, money forfeited by the assessee has to be reduced from the cost of acquisition, and indexation would be calculated on the costs so reduced while computing the capital gains when the capital asset is transferred or sold. Money forfeited by the assessee has to be reduced from cost of acquisition. So while computing the capital gains, first we will take full value consideration and we are going to reduce the expenses incurred and cost of acquisition. From such cost of acquisition amount, first we are going to reduce the money forfeited by the assessee. If the advance money is received and forfeited up to 31st March 2014, we are going to reduce such advance money forfeited from the cost of acquisition when the capital asset is transferred or sold. At the time of computation of capital gains on transfer or sale of asset, we are going to reduce such advance money forfeited from the cost of acquisition of such asset. Then we are going to take such reduced cost of acquisition while computing the capital gains. If such advance money received on or after 1st April 2014, here there is a mistake. I have mentioned up to 1st April 2014, but it is after, on or after 1st April 2014. If advance money is received on or after 1st April 2014, such advance money received would be taxable under the head income from other sources. Up to 31st March 2014, we are going to reduce such amount from cost of acquisition of asset while computing the capital gains on transfer of the asset. But from 1st April 2014, such advance money received will be taxable under the head income from other sources. With this, we have completed section 51. Now, we have seen the cost of acquisition of different, first while computing the capital gains, we take full value consideration, full value of consideration received or accrued. We have seen what are the different circumstances, some special circumstances where the full value of consideration, the deemed sale consideration differs, like under 50C or 50CA, 50D. After that, we are going to reduce any expenditure incurred. From net, we will arrive at net sale consideration. From the net sale consideration, we are going to reduce cost of acquisition or improvement. What is the cost of acquisition for different assets under different circumstances we have discussed before. After that, if the asset is long-term capital asset, we are going to provide for indexation benefit. Then we will come to exemptions. Exemptions under 54. If there is any exemption under section 54 related to such capital asset, we are going to reduce such amount to arrive at the capital gain amount. So what are the exemptions under section 54? Let us discuss now. Before heading to section 54, there are certain exemptions under section 10. There are two exemptions under section 10 related to capital assets. Let us go through them one by one. The first one is compulsory acquisition of urban agricultural land. In case of compulsory acquisition of urban agricultural land, we know that rural agricultural land is not a capital asset, but urban agricultural land is considered as a capital asset. Hence, on transfer of such capital asset, capital gains will arise, which will be taxable under this head. So, what is the exemption related to urban agricultural land? On its compulsory acquisition, if the assessee is individual or HUF only, this exemption is applicable. The land should be used for agricultural purposes by the assessee or his parents or HUF for 2 years immediately preceding the date of transfer. This is the condition number 2. If the assessee is individual or HUF, he will be eligible for exemption under section 10 with respect to compulsory acquisition of urban agricultural land. And the second condition is the land should be used for the purpose of agriculture, either by the assessee or his parents or the HUF for 2 years immediately preceding the date of transfer. This is the condition number 2 to avail the exemption under section 10. The consideration for such transfer is determined or approved by the central government or RBI. On compulsory acquisition, the consideration received by the assessee is determined or approved by central government or the RBI. This is the third condition. The capital gain will be exempt provided the compensation or consideration for such transfer is received on or after 1st April 2004. If the compensation or consideration amount on such transfer is received on or after 1st April 2004, the capital gain will be exempt, subject to the condition that land should be used for agricultural purposes by assessee or his parents or HUF for 2 years immediately preceding the date of transfer. The consideration is determined by central government or RBI. The eligible assessees in this case are only individuals or HUF. And this exemption is applicable on compulsory acquisition of urban agricultural land. Let us now move to the second case. The amount received by the senior citizen as a loan, either in lump sum or in installments, in a transaction of reverse mortgage would be exempt from income tax. Here the senior citizen is receiving amount in form of loan. Either the loan is provided in the lump sum amount or in installments, in a transaction of reverse mortgage of his capital asset. Then such amount received will be exempt from income tax. The amounts are received by the senior citizen will be exempt from income tax. Now let us head to the last section, that is section 54. Section 54 deals with exemptions. So, under section 54, there are total of 5 cases. The first one is section 54 with the eligible assessee. The assessee who can claim exemption under section 54 is individual or HUF. The asset, the capital asset for which this exemption is applicable, the asset transferred is residential house. Generally, on transfer of the asset, the capital gain is computed. On such computation of capital gains, we are going to deduct the exemption amount. Only when a capital asset is transferred, we are going to compute capital gain, and while computing the capital gain, we are going to reduce any exemption amount under section 54. So the asset which is being transferred here is a residential house, which is a long-term capital asset. The qualifying asset. This exemption under section 54 will be applicable only if the assessee is transferring one capital asset and is acquiring one more capital asset. When we are talking about section 54 only, the qualifying asset is 1 or 2 residential houses in India where capital gains does not exceed rupees 2 crore. The asset is transferring one residential house which is long-term capital asset, and he is acquiring 1 or 2 residential houses in India itself, and the capital gain on such transfer does not exceed rupees 2 crore. The time limit for purchase or construction. The residential house either can be purchased or constructed. The purchase should be within 1 year before the date of transfer, or 2 years after the date of transfer, or construction within 3 years after the date of transfer. 1, 2, 3. Either purchase within 1 year before the date of transfer, or purchase within 2 years after the date of transfer. In case of construction, construct within the 3 years after the date of transfer of the residential house which is long-term capital asset. The amount of exemption. What is the amount exempted on capital gains arising on transfer of the residential house? Lower of cost of new residential house or 2 houses or capital gain is exempt. The maximum amount of exemption is rupees 10 crore only. If it exceeds 10 crore, we cannot claim the excess amount. Up to 10 crores only the exemption can be claimed. And the exemption, the exempt amount could be either lower of either the cost of new residential house or 2 houses. If assessee acquires 2 houses, cost of new residential houses or 2 houses, or the capital gain, whichever is lower, will be exempted. Other conditions. Income from such household should be chargeable under the head income from house property. We are transferring the residential house, no. So, the income from such residential house which has been transferred by the assessee is chargeable under the head income from house property prior to the transfer of the asset. In such a case only this section 54 will be applicable. Once again I am repeating the amount of exemption, which is the important point. Lower of cost of new residential house or two houses or the capital gain is exempt. Either the capital gain amount or cost of new residential houses, whichever is lower, will be exempt, and maximum amount of exemption could be up to rupees 10 crore only. You cannot claim exemption exceeding rupees 10 crore. Now let us move to the next section, section 54B. The eligible assessee is individual or HUF. Here the asset which is being transferred is urban agricultural land. And the asset which the assessee is acquiring now after the sale of urban agricultural land is land for being used for agricultural purpose only. It might be urban or rural. He is selling one urban agricultural land and acquiring one more asset which is also a land, and he is going to use such land for agricultural purpose, and such land may be situated in urban area or rural area. The time limit for purchase or purchase within a period of 2 years after the date of transfer. He can purchase the new land within 2 years after the date of transfer. Only if he purchases within such period, he can avail of section 54B exemption. Lower of cost of new agricultural land or capital gain is exempt. Similar to the previous case, either the cost of new agricultural land or capital gain, whichever is lower, is exempt. The condition to be satisfied is land should be used for agricultural purposes by the assessee or his parents or HUF for 2 years immediately preceding the date of transfer. The land which has been transferred before and land which is now being acquired, they are used for agricultural purposes only. The land which is used before, the urban agricultural land, should have been used for agricultural purposes only by the assessee or his parents or the HUF for 2 immediately preceding the previous years, 2 years immediately preceding the date of transfer. Now let us head to the next section, section 54D. Here the eligible assessee is any assessee. Any assessee who is transferring land and building forming part of an industrial undertaking, and he is acquiring an asset which is land or building or right in land or building. He is transferring land or building which is forming part of an industrial undertaking. Now he is acquiring either a land or building or any right in such land or building. The time limit for purchase is purchase or construct within 3 years after the date of transfer for shifting or re-establishing the existing undertaking or setting up a new industrial undertaking. To shift this previous industrial undertaking, he is going to purchase or construct the new land or building, or he is going to acquire the right in such land or building within 3 years after the date of transfer of the previous asset. And within these 3 years, he has to purchase or construct for shifting or re-establishing such industrial undertaking. The amount of exemption, similar to previous cases, is the same. Either the capital gain or cost of new asset, whichever is lower, is exempt. Lower of cost of new asset or capital gain is exempt. The other conditions which are to be satisfied is land and building have been used for business of undertaking for at least 2 years immediately preceding the date of transfer. The land and building have been used for business of undertaking for at least 2 years immediately preceding the date of transfer. The transfer should be by way of compulsory acquisition. Here, the assessee is not transferring the land and building of the industrial undertaking on his own discretion, but such land or building are being compulsorily acquired by any authority. Only in such a case, section 54D will be applicable. The next section, section 54EC. Eligible assessee is any assessee if he is transferring land or building or both, being a long-term capital asset. And now he is acquiring bonds of NHAI or RACL or any other bond notified by central government, which is redeemable after 5 years. he has to purchase such bonds of NHAI or RACL or other bonds notified by CG, central government, within a period of 6 months after the date of transfer. Starting from the date of transfer, within a period of 6 months only, he has to purchase bonds of NHAI or RACL or any other bond notified by the central government. The time period is 6 months only to acquire the new asset. Exempt amount is lower of capital gain or amount invested in specified bonds. In the previous cases, we are taking cost of acquisition of assets. Similarly, here the amounts are invested in specified bonds or capital gain. Whichever is lower is the exempt amount. Maximum permissible investment out of capital gains is rupees 50 lakh only, whether such investment is made in current financial year or subsequent financial year or both. There might be a case where even if the period of investment, the assessee is investing in such bonds within the 6 months, but the financial year is changing. If the time period is within the 6 months, in spite of there is a change in financial year, if the assessee invests in current financial year or subsequent financial year or both the years, such amount invested within this period of 6 months from date of transfer will be exempt, will be considered as amount invested in specified bonds. Amount so invested should not exceed rupees 50 lakh. It should be up to 50 lakh only. And out of the amount invested in such bonds or capital gain arised on transfer of the land or building or both, whichever is lower, such amount will be considered as exemption under section 54EC. I hope it is clear for you. There is no other condition for section 54EC. So let us head to section 54F. The eligible assessee is individual or HUF. Any long-term capital asset other than residential house is being transferred. In first case, section 54, already residential house is transferred. Now, other than residential house, any other long-term capital asset is being sold or transferred. On such transfer, the assessee is acquiring one residential house situated in India. He is transferring other than residential house, and now on transfer of such capital asset, he is acquiring one residential house situated in India. Such house should be either purchased within 1 year before the date of transfer or 2 years after the date of transfer, or constructed within 3 years after the date of transfer. 1, 2, 3. Purchase within 1 year before date of transfer, purchase within 2 years after the date of transfer, or construct within 3 years after the date of transfer. The exempt amount is cost of new residential house if it is greater than or equal to net sale consideration of original asset. The entire capital gain is exempt and maximum exemption is rupees 10 crore. If the cost of new residential house acquired by the assessee is greater than the net sale consideration of the long-term capital asset which is sold, the cost of new residential house is exceeding the net sale consideration, then entire capital gain is exempt. But it is subjected to rupees 10 crore limit. Maximum exemption limit is rupees 10 crore. Up to rupees 10 crore only the exemption is available. You cannot claim excess exemption. Assessee should not own more than one residential house on the date of transfer. On the date of transfer, the assessee should not hold more than one residential house. This is the other condition. And also, he should not purchase within 2 years or construct within 3 years after the date of transfer another residential house. Only this one residential house should be acquired by him. Within 2 years or 3 years, he should construct only this one residential house. Other residential house, the second one, should not be purchased within 2 years or should not be constructed within 3 years after the date of transfer. This is the condition for section 54. With this, we have completed discussing the exemptions under section 54. And regarding section 55, it also deals with cost of acquisition. We have covered such cases before. Now, we have completed discussing the whole chapter of income from capital gains. Let us discuss the further topics in the next videos, in the upcoming videos. And I hope you find this video helpful. Please keep watching our videos and thank you.